Welcome back, everyone. This is episode 206. This week, I'm joined by a special guest, Matthew Bartolini, who is head of ETF Research at State Street Global Advisors. Welcome, Matthew.
Yeah, thanks for having me.
Yeah, for those that have been listening to this podcast for a while, Matt came on probably about 2 years ago. We did a few episodes on ETFs, just like a broad overview. So we're back. He's back to talk ETFs, and we're going to talk about some of the trends going on in ETFs, as well as what's going on in the fixed income market, and how investors can try to tackle some of those challenges. So definitely going to be a good episode. So Matt, tell for the people that didn't catch the last episode just a little bit about yourself and what you do with State Street.
Yeah, so I head up the ETF Research team here at State Street Global Advisors. It's a team of about 16 individuals focused on providing market commentary, thought leadership, portfolio construction ideas, ETF education, and then subject matter expertise for a variety of our strategies to really help clients make sense of not only what the world is and the market, but also how strategies can help achieve their long-term sort of stated goals from an investment's perspective.
Yeah, and you guys do put out a lot of research, and a lot of it, too, is available to maybe all of it to the general investing public, right?
Yeah, I mean, we try to make sure that it's not only applicable to wealth advisors, but also to their end clients, because ultimately that's what we're really trying to focus on, is to build those better relationships and provide data-driven insights so people can make better informed decisions overall. I mean, one of the things that we just wrote, which was born out of a conversation with an actual end client in the, not an advisor, but their own client, was around investing around the elections. Okay. And we wrote 5 things to remember about election investing, and, not to bury the lead or suppress any of the clicks that we might get from it, is basically sort of just sticking to your plan. And again, that came out of a conversation where, a client was like, there's an election coming. Should I just go to cash? And we're like, no, because if you had done that every year since 1946 when there was an election, you would have underperformed the S&P 500 by 9,000% cumulatively. So,
wow, okay.
While elections matter greatly on an individual basis from a market's perspective, it's not as big of a driver of near-term performance.
Yeah, not to go off topic, but it's certainly a question that I've been getting from clients as I've been doing client reviews, and it's obviously a very polarizing election, right?
Yeah.
Each side believes the world is going to end if the other party gets elected, and it's making people concerned, and a lot of people are concerned. Oh, should I get out of my portfolio or reduce my equity exposure, because of what might happen?
And that's why we wrote this, and we have a line in there, and I think it's very appropriate, is that elections matter greatly, but from a market's perspective, they sort of don't have the same impact on a long-term basis. And I think that's the biggest driver, is that we always want to talk about long-term wealth creation, long-term asset allocation planning, and just sticking to that plan over a long time frame, which requires a lot of patience, but also a lot of purpose to what you're sort of striving for, which is retirement, meeting other goals. And again, it's just going to be probably a question that comes up a lot. So we wanted to put some pen to paper and, again, lead with some really data-driven insights, because we know it can be an emotional topic. And we sort of just put the data out there and was like, this is kind of what happens.
Yeah, no, that's great. It's something that I tell my clients, but hearing it from somebody else can be helpful, I think, as well. Because, the markets they're based on, profitability of companies, right? And so that's probably not going to change overnight just because we get a new administration in there. So, that's some good advice. And so I'll put a link on that in the show notes. Again, this is episode 206. So go to retirewithRyan.com/podcast/206 to get to, be able to read that piece. So, let's talk, I mentioned earlier, talk a little bit about like what's going on, with ETFs. Talk about some of the trends that's going on. with ETFs. And just as a reminder, what an ETF is, it's a type of mutual fund that's an exchange traded fund. And that's predominantly what we use for our client portfolios, and could be appropriate for your portfolio too.
Yeah, so ETFs, they trade like stocks on an exchange, but they're like mutual funds owning multiple different investments in a transparent manner. Like that's sort of the very quick and easy way to explain it. And ETFs are a very integral part of wealth management and just portfolio asset allocation. So as of we stand today in the US, there's over 9 trillion of assets invested in ETFs. So that's a new record high, and it's actually the first time it has ever gone over that $9 trillion mark. The other thing is this year, ETFs have taken in roughly $290 billion.
Wow.
So if we look out on a projected basis, we're probably going to do in the US listed ETF industry roughly 630 billion or so, maybe even 700 if there's a pretty sizable Q4 bump, because we're only in May and we have 300.
Sure.
So there's a lot, even just double that, you're at 600. So 700 is not out of the realm of possibility. And, it still would be below the all-time high in 2021, which was 900 billion. But, there's been a lot of focus on ETFs. And I always say, and I presented to other parties this past week about, there's 3 sort of secular drivers underpinning these flow trends. The one is low-cost ETFs. So ETFs that have a very low expense ratio. We have some that have an expense ratio of just as few as 2 basis points, so 0.02%. Yeah. So if you invest, $1,000, all you're paying is $2 in fees. Pretty cost efficient. Those are asset allocation tools. They cover the S&P 500, the bond market, small caps, emerging markets, and you can build pretty diversified portfolios. And the industry of low-cost ETFs accounts for roughly 60% of the flows this year. So a really strong showing and a really strong preference for cost, but also tax efficiency. Those low-cost ETFs last year, not one of them in the industry, ours included, paid a capital gains distribution. Meanwhile, about 35% or so of mutual funds did. So there's a lot of cost and tax efficiency there, but also transparency and the ability to access other markets too. The second trend is actually sort of, I would say, in inverse to it, and these are mutually exclusive, is that active ETFs. Active ETFs have really sort of come onto the main stage of the ETF market in the past few years or so. In 2021, they broke records of flows. In 2022, they did. And in 2023, they took in $136 billion. And now, as we stand in the middle of May, they've already taken $100 billion of flows. So Sure. They're likely to go over $200 billion. And that would be the first time that has ever happened.
Yeah, so for somebody who doesn't know, like just a quick, what's an active ETF versus a passive one?
Yeah, so a passive one would be something that tracks the S&P 500 or the Bloomberg Barclays U.S. Aggregate Bond Index.
Sure.
And it's rules-based, and it's a methodology, and there's no active stock-picking component to it that you think NVIDIA is going to do better than Meta or Facebook,
Sure.
or Google is going to do better than Apple. It's here's what the rules are, and we're going to follow those rules.
Yeah.
An active one could be a variety of things. One is just a stock picker, right? They do think that NVIDIA is going to be the greatest thing in the world, and they're going to own the most they possibly can.
Sure.
And they're going to try to beat a benchmark. There's also more outcome-driven active ETFs, which perhaps are seeking to just lower the volatility or the drawdown that you would feel, and they could do that in a variety of reasons. Or an active ETF that is maybe seeking higher income levels than what the market could give you, and they're doing that by investing in a variety of instruments.
Sure.
So that's the way I always think about it. And then I guess the third theme is just fixed income ETFs that are underpinning this growth, and that does sort of span across both low cost and active. Those funds have taken in $200 billion every year for the last 5 years, and they're likely to do that again. And I think that just speaks to the increasing use cases that ETFs have within bond markets, and just we've seen really strong growth there.
Yeah. So what are speaking, you ended with the bond market. Like maybe give like a brief recap. What's going on in the bond market. As of late.
Yeah, it's not great out there from a returns perspective. Higher rates have dented returns once again. So, I keep referring to the Bloomberg U.S. Aggregate Bond Index. That's your sort of heritage index. Think about, for your listeners, it's like the S&P 500 for bonds.
Sure.
That's down this year. It's now continued to be mired in a double-digit drawdown for now 2 consecutive years, because as interest rates go higher, bond prices go lower, and that actually leads to losses. At the same time, the volatility, so the day-over-day change in in that bond index, is actually at some of its highest levels it's ever been. So you have losses, and you have this painfulness in sort of day-over-day returns, and all of that is because of monetary policy evolving. We have high interest rates. We don't know when the Fed will cut rates. They keep sort of pushing those rate cuts further and further out as inflation remains sticky. So, being a bond investor has been somewhat hard from a returns angle. The income levels are higher because rates are higher, but it has been a little bit challenging. And we think, in those challenges, be more selective, maybe owning some corporate bond exposures that maybe, take on some credit risk is beneficial, because they are not so impacted from a day-over-day change in rates as, say, treasuries might be.
Sure.
And that's, I guess, the last really interesting thing I think many people probably don't realize is that the volatility, the day-over-day change in returns on long-term treasury bonds is actually above that of the S&P 500, so equities right now. And
Okay.
typically that's not the case. Typically, equities are much more volatile than treasury bonds. And I think that speaks to the anomalous volatility environment, but how rate volatility is really a big risk right now. And it stems from, I would say, monetary policy uncertainty.
Yeah, right. That's the big unknown, right? When is the Federal Reserve's, or we could start by saying, what's going to be their next move, right? They didn't raise rates their last meeting. They didn't lower rates also. I think like consensus, I mean, you could probably speak to this, is that they're going to cut rates. I think was the consensus like for 2 rate cuts this year, going into the year?
So, going into the year, the forecast was for by July to have about 100 basis points of cuts. Where we stand now, there's none. So,
Sure.
forward-looking market pricing indicates that there's going to be no cuts in July. And at the start of the year, there was anticipated, I believe, to be almost 200 basis points of cuts by year end. Right now, it's just one. So everything's been repriced to be higher for longer, because inflation has been stubborn and sticky.
Sure.
And, so what their next action is going to be, their next meeting, is a hold. They're gonna have a holding pattern, so to speak.
Yeah.
They're gonna be like every other plane out on LaGuardia on a rainy day, just in a holding pattern.
Yeah. Lots of circling. Hopefully not circling the drain. So
no, hopefully not that.
So, if I guess it depends what your viewpoint is. If you think that rates aren't going to be cut, like what you were speaking about earlier, maybe improving or taking on some credit risk could be a better decision.
Yeah, so I think what we're doing, and we're in the process of writing our sort of implementation ideas for the second half of the year, our current market outlook, and I think what we're thinking is that it's all about balance. And if we know that death, taxes, and Federal Reserve policy uncertainty are the 3 true outcomes, for the last one, maybe try to mitigate some of that uncertainty and own areas of the bond market that have less rate volatility. And so some of that could be floating rate senior loan exposures. They don't really have a lot of rate volatility because their interest rates float, right? So there's the ability there. The other area would be maybe intermediate corporate bonds, so high quality intermediate short-term corporate bonds that don't go all the way out to 30-year maturities, but maybe sit within the 1 to 10 year, because it can give you a little bit more of a balance. And that's all we're really thinking about, is how do you balance these risks while still trying to provide diversification and income because the yield curve is, still inverted, and there are some opportunities on the short end to drive income.
Yeah, so you could, I guess, if you were mostly using a bond index fund, right, like the Barclays Ag, you could just sit there, or you could try to do some things to improve your performance in the short term, right? If it doesn't look like there's probably much change happening, in the next 6 months.
Yeah, I mean, I think part of it is, if you look at the ag, and again, that's that S&P 500 bond like index. The volatility of it is quite high. If you just move into the shorter end of it, and say a 1 to 3 year or 1 to 5 year maturity space, your volatility declines, but your yield doesn't.
Sure,
So
yeah,
your income, your potential return, is actually in some cases, if you're just thinking 1 to 3 year corporate bonds, is actually above that of what you get in the ag. But you're taking on, instead of 6.5 years duration, you're taking on 2 years of duration.
sure. Yeah, that's what, for people who don't understand, like just explain, you mentioned inverted yield curve. Like, what does that mean?
Yeah, so that means yields on 3 month treasury bills are above that of 10-year treasury bonds.
Okay.
And typically, the reverse is true. Your yield on a further, if you're lending money longer term
Yep.
to the government, the yield that you're going to be charged is going to be above that of something that we are lending short term.
Sure. And why is that normally the case?
Well, I mean, if you're lending something, you have more risk if the length of your loan is much longer. Something could happen. I mean, of
Sure.
course, the creditworthiness of the U.S. Government is pretty good, but overall, the longer you lend something, the higher the rate typically is.
Yeah. So yeah, it's so you're getting paid to not take on more duration risk, I guess, right? More long term bonds. But what's like the risk? Let's say you said, you know what, I can just hunker down in like 1 year, treasury or corporate bond, whatever it is. Why shouldn't I just put all my money into that like right now versus
Yeah, I mean, part of it is, if rates do decline, if you're out on the 10-year or 30-year bond, those lower rates could lead to stronger gains from duration induced price appreciation.
sure.
Yeah, but again, the volatility that you're taking in terms of that allocation is
Yeah.
quite high.
Yeah.
So again, it all goes back to the balance idea. How do I
Yeah.
sort of balance and optimize my income level for a given area of risk? And I think there's really strong opportunities in those lower duration bond segments, in maybe floating rate senior loans, which you are taking on some credit risk, right? Because those are below investment grade securities. And that's why we really think actively managed senior loan strategies are worth consideration, because active managers can use security selection and sector selection and credit selection to potentially mitigate some of the concerns around credit, all the while still having a volatility profile from a rate perspective that is quite low. So there's a lot of opportunities, I think, out there to address some of the challenges within fixed income, and that ETF marketplace has grown in size, where there's a significant number of actively managed fixed income ETFs that have identifiable track records that you can really perform a lot of due diligence on, but also understand what their return path might be, their liquidity path is, their volumes. So there's no shortage of opportunities out there to address some of these challenges in the marketplace.
Yeah, that makes sense. Because we don't know, what this. I mean, nobody ever knows what the market's going to do, but I would say even now it's a little more uncertain. We don't know how long this is going to be like this with the Fed. I mean, they kind of some would say maybe they waited too long initially to raise rates, and then now they're going to maybe wait too long to lower rates.
Yeah, and I think also the biggest problem too is that they've said under this push for patience that they'll be data dependent. And the problem is that some of the really important data releases have become more volatile than normal. So if we look at CPI, the Consumer Price Inflation Index, and that's a big driver of inflation readings. I know there's multiple other ones that the Fed will look at, but if we look at CPI and we look at what consensus estimates were up until the day of the release, so what were economists expecting for CPI to be, say they expected it to be 3.5% year over year. Well, on average this year, CPI, when it actually gets released, is about 10 basis points, so 0.1%, away from consensus estimates. That doesn't seem like a lot, but historically, on a pre-pandemic average, it's usually about 7 basis points. So it's a little more volatile or variable than normal. And I think part of that obviously has to do with the effects of the pandemic and the ability to capture different economic data given the changes in socioeconomic behaviors. But we've also seen that within labor. Labor reports are surprising by a change, an absolute change of 50%. Typically, it's around 30%. So these very key economic data reports are really variable. So being data dependent has actually led to more volatility, because on days in which these very key economic data indicators, and there's many more too, you look at producer price indices or what have you, the volatility in the market around those days of really important economic releases is above what historically would have been in past years. So those days are becoming like mini Super Bowl events for the market.
Sure.
And again, this is a super technical term, but if we look at the volatility curve, right? So just think about like forward-looking expectations of volatility.
Yeah.
There are spikes in the volatility expectations over the next 2 months around 3 key events. One is NVIDIA's earnings, because NVIDIA is such a big stock
Sure.
now. The second is CPI, and the third is the Fed meeting. So the market's like, hey, you know what? Those days probably going to be a little bit more gyrations than normal. So that's kind of the problem right now with being data dependent, is that everyone's going to try to figure out your next move when the data comes out, and you're not going to tell anyone what your next move is going to be until maybe a month later.
Yeah. Yeah. So people are either betting with the market or against it on what they think this data is going to be. And then we see what it is, right?
Yeah. I mean, to make a sports analogy, it's sort of like trying to predict, which NFL rookie is going to be the best rookie. You have no idea. There's 7 rounds, 200 players, poor track records of drafting quarterbacks at the top. Yeah. It's a pretty ambiguous market environment from a policy perspective, and that creates some near-term volatility.
Yeah. So do you think what you said earlier, I mean, have an asset allocation and stick with it, is probably some of the best advice to deal with, what's going on?
Yeah, I mean, I think that's your starting point. Strong foundations lead to a strong house, and your asset allocation are those foundations. I think, much like, again, using that same analogy on housing, you can always make some alterations, some modifications to meet the current standards or the current market environment. You obviously have need to get a new lawn if it rains too much, and things like that. So in this current market environment, if you know that the volatility in your bond portfolio is a little bit higher than normal, maybe don't remove all of your bonds. Just maybe change it up a bit. Sort of adjust. So I think your core asset allocation of stocks, bonds, and maybe alternatives stays. But what you're doing in those buckets can change a little bit based on the market environment. But the changes can't be in one thing and out of the other. It's all, like in life, slight moderations to sort of course correct the overcorrections and undercorrections.
Yeah, makes sense. Anything else you want to leave us with before we wrap up this episode?
No, I mean, I think, look, the ETF marketplace is something that I look at on a daily basis, given my role. It's fascinating. There's a lot of different strategies out there. with a lot of different strategies. It requires a lot of due diligence and information and insights. And I think my team is really helpful in providing that, not only to wealth advisors, but to end clients as well. And we continue to strive to provide that level of commentary around a lot of market events like the election, like Federal Reserve policy, in addition to just even general trends of what the market might be doing in a day, a week, or a monthly basis. So I'd always just say, go to ssga.com to find some of our latest content and latest materials. And, the ETF market will only continue to grow, I think, from here on out. And I think it creates a lot of fascinating topics and a lot of fascinating opportunities to help, create long-term wealth as well.
Yeah, definitely. Are ETFs, are mutual funds, do they still have more assets than ETFs?
They do.
Oh, okay.
Yeah. They've been around a lot longer.
Yeah, no, I know.
A little bit more of a runway.
Well, is there a projection on when that gap might be closed?
It will be closed.
Yeah.
I just don't know when.
Sure, of course.
Right.
Yeah.
There's a market compounding effect that will take place. Yeah. So bigger assets will still grow.
Yeah.
But the trend is towards ETFs. I think if you look at on a relative basis, ETFs I think make up over 50% of that allocation now. Or no, that's passive. Sorry, that's passive ETFs.
Oh, yeah.
It's going to grow. Yeah. I just don't know when.
Sure. Yeah. Awesome. Well, thanks so much for coming on this week. Thanks for updating us on what's going on in the markets and some other helpful info. And again, I'll put a link in the show notes, for the links we mentioned. And as always, if you have a question for a future episode, you can leave it by going to retirewithryan.com. Thanks again, Matthew.
Thank you.
All right. Have a good week, everyone. Talk to you next Wednesday.